Let's have a look at the EUAs. Since September, the market has been just long only. So just gains after gains after gains after gains with intermittent sideways ranges. So this has it made super difficult for anyone to like buy into troughs. This is near impossible because we only have the ranges and then we continue higher a little bit. Not really ideal for trading. On the 15th of January, we forecasted that the EUA was going down despite being in a very strong bull trend. Look at this here. On the 15th, we are saying that the market is more likely to go down because the algos were set up for the market to go down. So that's where we got this from. So here's the thing. Why did we think this? So the UA bull runs have not crossed beyond 17 over the past 3 years. Remember, as the bull trend continues, and we are in a strongly trending market, we are just going, okay, 13, 14, 15, 16, 17. And this is usually as far as it goes, at least over the past 3 years. And this is when we see the rubber band usually snap back. We get a mean reverting market. And this is exactly what happened. We predicted that the market will go down, and that's exactly what happened. On the daily chart, we already saw the market to potentially come down as we reached this upper channel boundary. So this is where our classic TA comes in. Then we do have 2 days with these long-legged dojis, or however you want to call this, doji stars, where we simply see that the bulls were trying to push higher but couldn't quite make it. So on the hourly chart, this looked like a double top reversal pattern. So we got this bearish call earlier than the market before the market even started to print these bearish candles. What has happened since then? In the last 2 sessions, the market has cooled off back into a non-trending regime. This is super important because instead of our algos showing us that we are now trending bearish, it's just saying we are neutral. So we are not bullish, we are not bearish, we are just neutral. As the market is making these really dramatic 2 day declines. Interesting. So what's happening next? Well, let's have a look at the classic TA. Right now, we are finding support at the 83.43. And we do think there's maybe a little bit more room to decline for the market if we make it, and we could potentially make it towards the 81, which are just 2 consecutive support levels, support troughs. So we do see that the stochastic is moving lower. We do see that the momentum is declining, not bearish yet, but it is declining. And we do see that on the hourly chart, for now, it has been looking quite bearish. But we are careful now, and we are not 100% convinced of a further decline here. Maybe just a little bit, but not too much. What I want you and everyone to do now is start scanning for the market to bottom out in the 83, 82, 81 area. I know it's a wide range, so do look at the hourly chart for earlier signals. Because here's the thing. Right now, we are at a -4, right? Forecast state -4, while the market is not trending, which usually means that there's a higher chance for positive returns in the next 8 sessions. So there's a greater chance for the market to bounce.